Sure, I appreciate it, George. Thank you for the opportunity. I guess to give people a little bit of background on myself, maybe I'll just start with that because maybe not everybody's heard of me, but I've been in the financial business since 1992. Came up through Dean Witter back in '93. Then started my own registered investment advisory firm in 2001. Started a hedge fund at the same time. By 2006, it was mainly a long short fund, and then by 2006, I kind of saw this entire melt up happening. Massive leverage, banks 50 to 1 leverage, all this kind of stuff, and I thought this is not getting good. So I started looking at alternative assets as a way to store value or store money outside the system, and the precious metals at the time made the most sense because it's had all the history to it, as well as it was a bearer asset. You could store it outside the system and have complete privacy. So what I did was I switched my business, switched the hedge fund to owning physical gold and silver held outside the financial system, and then secondly, I looked at where to store it. And at the time, every depository, and it's still true today, every depository is either owned by or affiliated with a gold dealer, a financial institution, or a cash in transit company, kind of like a Brinks, for example. And so the industry is set up on a model of transactional revenue. It's not really set up on a custodial type of basis where the storage fee revenue sort of supports the all the actions of that company. So I ended up starting my own depository in 2008. We went live in 2010, and then have just been growing ever since. We store over 800 million in assets at our facility now, which is in Idaho. We have a full all risk insurance policy through Lloyd's of London. The hedge fund I manage, it's still invested in physical precious metals. The breakdown, just for full disclosure, is about 69% silver, 29% or so gold, and about 2% platinum, which I started picking up back in March of this year. And I was very vocal and very I try to put out as much as I can on Twitter, reasons why I do what I do, to try and help people, you know, try to understand more of the market structure and use some technical analysis and charts as well as some of the fundamental stuff. And the charts were just lining up on platinum, which I had shown. So I started to take that position. So it's really the essence of why I got into the metals was because of counterparty risk and systemic risk. Those are the two main risks that paper assets ultimately cannot diversify from. I mean, we looked at in 2006 when I saw this thing melting up. I didn't know 2008 was going to happen to its degree, but I knew at some point all this leverage didn't mean rainbow and unicorns. And so what you learn very quickly being in the business as long as I have, watching Orange County go bankrupt, and the all the long-term capital management and all the bubbles that we've seen, and so forth. You can't always rely, as the winner of the trade, you can't always rely on the loser to pay you, and that's something I've kind of simplified down. So hopefully that gives you a little bit of background of why I do what I do. So risk management to me is absolutely crucial. I look at risk before reward, especially when you're running a depository. You're looking at all the risks, not just simply going concern risk of a depository and the industry as a structure, but you're also looking at, nationalism, fascism, socialism, nationalization, confiscation, taxation. There's a myriad of different things to look at when you're getting involved with the metals. And then of course you look at, the different structures that you can invest in. Being that I've been a registered investment advisor since back in the early 90s, I'm very familiar with securities and all the rules and regulations. So, comparing GLD, for example, or SLV, which is the two big ETFs out there, you start to understand what you're actually buying legally, what you own, what you don't own, who actually owns it. And again, when you're looking at counterparty and systemic risk, you're trying to separate really the system from your exposure. And the metals to me make the most sense. I know everyone's going to say, well, what about Bitcoin? What about it? I mean, it hasn't been truly tested in a really down market, and where the Fed doesn't come in to the rescue. The one nice thing about metals is they have that thousands of years of history behind it, and the rest of the world is this isn't just a U.S. centric story anymore. It's really the entire world from a standpoint of leveraging up and the debt cycle and that type of thing. So it's you're looking for something to tangible to actually hold on to, and that's what human history kind of tells us is that I'm sorry, hard assets typically people gravitate to because it's what you hold in your hand that you can trust. And so hopefully that gives a little bit of background on myself.
That's really helpful, Bob. So let's get into it. So you have say you have a physical depository. Mining, you gotta just sit tight for a while. The floor is mine. We'll get you in a few minutes. Um, so you got a physical depository. So for those of us sitting at home, what does that mean? Instead of you having a wine cellar, you got like this thing underground with all this metal. So like if I came out to visit you, you could take me to some place, a hole in the ground where, it's all the big doors and everything, and it's you got all the metal actually in storage somewhere.
Yeah, we actually everything we do is fully segregated. So imagine, at the end of the Raiders of the Lost Ark movie, you look at all the boxes and crates piled up everywhere. Well, that's segregated storage in a way. Everyone's items are physically separated from everybody else's items. So there's no commingling of assets, unlike allocated storage, which actually is commingling of assets. And then you have pooled storage, which is really more of like a balance sheet financing operation on behalf. It supports the sponsor of the program, but you have to distinguish all these different types of methods of storage. So segregated storage is basically your metals are labeled in a box and not touching anybody else's metals.
Okay, and then what's the difference between allocated and you said there were two other types? I forget the
Yeah,
third one.
allocated storage is something a lot of gold dealers and companies out there that are that have structured programs will try to promote. So, for example, if you have a gold dealer that has an account at Brinks, but they call themselves a storage company, so in essence, they're what they call a master agreement holder, or they have a master sub relationship with Brinks, for example, and you're client A, and you store with dealer A. Dealer A is going to have the relationship with Brinks, not you directly with Brinks. So it's what they call this master agreement that the dealer controls the account. So in essence, the dealer may have a segregated relationship with Brinks, but they actually end up breaking down, each client A, B, C, and D on a spreadsheet. Let's just say. So
Hey,
there's
hey, hey, Bob, it sounds almost like a prime broker in the hedge fund business, no?
Yeah, very similar, very similar. And that's one methodology. There's also where you have a dealer that has or a structured program that has 1,000 ounce silver bar, and he has 10 clients that own one 10 or one 100 ounce silver bar each. So that 1,000 ounce bar represents 10 different people. That's allocated storage as well. And then
Yeah.
you have pooled storage, which is basically where you have sort of pooled credits where you have let's just say you own 1,000 ounces of silver. Well, that 1,000 ounces is represented in bars, not necessarily any particular bar, but the structure program just represents that you have some degree of exposure to assets being held by them. But they can actually take those underlying silver bars that they have, and they can move them around. They can do whatever they want with them. They can convert them into 1 ounce rounds, sell them for a profit, and then go out and buy another 1,000 ounce bar. So, and that's how a lot of structured programs are set up in the precious metals world, because you have to remember the precious metals world is a very unregulated industry. When you're talking about physical assets held outside the system, the CFTC or Commodities Futures Trading Commission gets involved typically when it's a futures or some type of swap type of arrangement, but or if it's delivery that's made beyond 28 days. But usually, with it's a cash purchase and deliveries made before 28 days, there's not much oversight, unfortunately. And this is where the dealer and promoter world has really taken advantage of people, especially post COVID, when all of a sudden it was hot to own metals, and then you saw these massive markups and so forth.
So, Bob, let's go with that a little bit more. I'm not going in any particular order, just the order in which the questions kind of flow into my head. So, let's talk about some of these ETFs for a second. I think people in this room, not just in this room, but people should know the difference. between, let's just take GLD to pick on one, or is PHYS, is Sprott stuff, all this stuff. Okay, everyone's different. I get that. Okay, but for as long as I can remember, there's always been these stories going around. Well, if the world comes to an end, the GLD won't have the gold you think they do, and blah blah blah, and it's paper gold, and it's not as good as the real deal, and yada yada. But the benefit of the GLD is just push a button and you can be in and out. So, could you talk about the differences, but specifically the what's important about the differences? I can't remember if GLD, all the stuff is held below, or supposedly held below, the Federal Reserve Bank in New York, somewhere in downtown Manhattan. And if you went in there with a flashlight, they actually don't have it, or they got 1/10 of what they say they do. Blah blah blah. So why is this important, Bob?
Yeah, GLD, for example, most of it's held well in London, and some of it's held at the Bank of England, some of it's held in like JP Morgan or HSBC. They're two main custodians for GLD. The premise is that they have the metal, because otherwise it would be complete fraud if they have all these audit reports saying that they had the metal but they don't have the metal. Where the rub comes in with ETFs is a couple different areas. One is ownership, legal ownership of an ETF, just like with every stock held in a brokerage account, is not the individual that has it in their brokerage account. The legal owner is actually Seed and Company, which is a limited partnership of the Depository Trust Clearing Corporation. So that's actually the legal owner. That's how all these shares trade back and forth, because they have one owner. I'm not sure if people really understand that. So that's the first premise. So in essence, when you own GLD or NVIDIA or whatever you own in your brokerage account, you're actually what they call a beneficial owner. So you the street holds it in your name for your benefit, but you actually don't technically control it. And so when
Except, let me interrupt. Except, isn't it possible you can elect your account, like on fully paid securities? You can actually make the election. Most people don't, to actually have it in your account. Or am I incorrect on that?
it used to be you could take certificate of it and then get the old paper certificate.
Mhm.
But I think most transfer agents and so forth don't even issue paper certificates anymore.
Okay.
That's
Okay. All right. All right. Keep going. I interrupt you. Sorry about that.
Yeah. So when you're looking at systemic and counterparty risk, again, you're looking at the idea of, okay, what do I actually own? And so when you look at these ETFs, and you have to also look at how the ETFs are structured. Typically with ETFs, they're supported by what they call authorized participants, who are the market makers and the broker dealers and banks that trade, that provide liquidity to the ETFs. So in essence, when you have a pile of money coming into SLV, for example, you may not have that pile of metal may not even really touch the exposure of silver, because ultimately the authorized participant may already have a massive degree of inventory they're sitting on that's fully hedged, for example, where they're long physical silver in London, they're short New York futures to hedge against that price volatility risk. So when you buy silver and you're thinking, I'm gonna really impact the market, all you're doing is just impacting the inventory of an authorized participant. That's where a lot of this price management and interference comes in with the marketplace, is the market makers themselves, versus an institution going into the market and actually buying physical silver and just saying, I'm going to take delivery of 1,000-ounce silver bars, whether they're in London or New York or wherever, and I want to buy actual silver. That would have a much greater impact. The problem you run into in the industry is that most money managers and hedge funds and endowments and pensions and all this, they're in their charters, they cannot, they're very limited to what they can buy. Typically, it's a fund or a security. They can't really buy physical assets. And in the broker dealer world, um, investment advisors and so forth can't charge a commission or a management fee on physical assets like gold and silver, because it's not a fund or a security. So that's one of the reasons why the financial industry has created all these derivatives, which an ETF is basically a derivative of the actually underlying metal.
So Bob, these concerns about said ETF doesn't actually have the metal, so on and so forth. Like, I get at some point that could be a problem, but heretofore, has it really even mattered?
It has, when you looked at, for example, earlier this year, and just to take one big step backward, just real quick, SLV, just take them for example. The top three hallmarks in SLV, two of the top three are China or Chinese bars and Russian bars. So you can make the case that what would normally go into the US can't actually go into the US. So therefore, the authorized participants use London as a sort of, I don't want to say money laundering center, but basically it can take in bars that otherwise would have either tariffs associated with it. Because right now, currently, anything coming from China since 2018 has a 25% tariff on it, and that includes bullion. So these bars get shifted over to London where they can trade a lot freer. And so just to mention that, what was, I'm sorry, what was
Yeah,
the
oh,
question?
no, but no, but hold on, let me put it another way. Let me put it another way, okay? So let's say Dilly decides she wants to buy some silver or some gold, right? Instead of buying the physical, she decides to buy an SLV or GLD, all right? And all she's really forget about the world comes to an end and they don't have it, all right? I'm just talking about in normal times, okay? Dilly thinks, gold's going to go up 10%, so she buys GLD instead of physical gold. She just wants to make sure that she made the right asset allocation, i.e., she wants to make a positive bet on gold. She doesn't want to buy some inferior piece of paper where gold goes up 10% and the ETF doesn't go up 10%. So like, I totally get what you're saying. I mean, they're playing all types of games, but in terms of delivering a product that tracks to the underlying, are these ETFs? I mean, there were other risks. I'm not saying you should give them a free hall pass. I'm just trying to understand what the risk is. So far, there hasn't really been a risk. That problem hasn't manifested itself, has it?
It actually has, but the way the authorized participants work with these ETFs is that they can paper over a lot of the impacts of market events, so it doesn't actually impact the premium or discount to NAV that these things trade at. So, for example, you take in earlier this year, or at the end of last year, Trump winning the election, tariff talk, all of a sudden the exchange for physical premium, which is the spread between New York futures and London spot or the physical market, all of a sudden there was this talk, well, they're going to hit 25% tariffs on everything coming into the US. And so a lot of people started to panic because all of a sudden you have a futures contract that you're using to hedge against a spot position, say in another country, for example, say London. All of a sudden, if you happen to have that bar, that hallmark, say from Canada, because there was a lot of spout going between Canada and the US at that time. If you had a Canadian bar that you were using a futures contract to hedge against, and all of a sudden you have to deliver that Canadian bar to New York to offset that futures position. Now you have to pay a 25% tariff on the
Wait,
value of that metal,
wait,
and
wait.
and
Yeah, I
and
get
that's
it.
not something you can hedge. And so what ended up happening was you had this massive tightening in the marketplace where all of a sudden people were rushing to bring metal to New York because they were worried that all of a sudden they couldn't hedge the tariff risk. It was truly it was a wipeout situation. So it ended up where lease rates went through the roof, financing rates went straight up, and then all this metal was coming into New York. And then you also had at the same time a lot of these equity companies or market makers like Citadel and so forth. Well, all of a sudden, metal was tight, physical metal was tight. Well, the next derivative of that is the ETF share. So all of a sudden, you started seeing this massive buildup in short interest and short activity in the underlying, or I'm sorry, the ETFs and closed-end funds like PSLV and so forth, because they were a lot of these market makers were using the ETFs as proxies for the actual physical because the physical was just too expensive to obtain. And so that actually created this massive increase in short interest. But it was then, of course, then you had that rollover into the options market. So everyone's hedging, and this whole thing is just rolling into this idea of, well, we just got everything hedged out. But the sad part was you had premiums that were going upward, meaning the spread between New York and the spot market were actually increasing, or the contango was rising. So it was pressing players that were short the market, and actually they were losing money. And of course,
Oh
it turned
boy.
out the banks were actually ended up making $500 million in that first quarter because they were actually taking the physical metal. They were buying it from everywhere they could get it. All the U.S. refiners, Canadian refiners, Mexican refiners, wherever they could get it, they were bringing it to New York, and they were actually shorting or selling the futures premium against the exchange for physical premium against the spot price of metal, and they made a fortune off of it. And and that, but these are things that can that could come out of the blue, and all of a sudden, you get one guy that says, okay, I want to buy $1 billion of metal. You That's like throwing a grenade right into the financial system of the precious metals world. It would basically disrupt all this market making activity.
Right. So Bob, so just on that point, I'm thinking back to you know enough about prime broking and stocks and shorting, all that kind of stuff. But yeah, so I want to use an analogy, and you'll say to me, "No, George, is different," or "No, it's actually instructive." So, Bob, you know when you have like a really tight borrow, like you have these failed to delivers, and there's a really hot stock, and some of these things never get delivered, and then the borrowing rate keeps going up and up and up, and then it's a question of wink, wink, broker A lets broker B get by, or a question of who they got to buy in first. There's no real law for that. It's all like, whose bread gets buttered the most, et cetera, et cetera. Is there a lot of monkey business that goes on in the background between the different players with respect to both physical and the financial?
It's a great question. The New York side of the market, the COMEX, the futures markets have a lot of eyeballs on it. There's a lot of reporting that they do on a daily basis. But when you go to London, that's a very obscure market. There's not a lot of reporting. There's not a lot of disclosure and so forth. So you really don't know what goes on behind the scenes. And then, of course, we had this whole thing with when all this metal was coming out of London, and you had the Bank of England saying, well, we really can't make delivery for the next 12 weeks. Well, we're getting it through this. It's like sticking, a gorilla, through a bird cage. That's what they were saying. Well, the door is only so big, and it's only a single wide door. We're trying to move, umpteen millions of ounces through it. It's going to take a while to get through. That's literally what they said.
Right.
That's the reality of you're dealing with a physical asset. The issue though is there's been so much money created, so much leverage created, and so forth. If you start to see, like J.P. Morgan came out with a report a couple weeks ago saying, listen, if everybody around the world just put a 0.5% weighting toward actual gold, it would send the price up to $6,000.
Right.
That's the reality of just the size of the precious metals markets right now. They're tiny compared to the equity and bond
Well,
markets.
you just touched on a really good point, which we probably should go into deeper exploration in another space, because it's not just relevant to the markets you're talking about, but just generally the size of the financial economy relative to the size of the real economy, the hyper financialization of everything. And all it takes is some of this fiat to target a particular asset, one which has a relatively inelastic supply curve. I mean, take Bitcoin as a good example, that or gold or whatever it is. Okay, or everyone decides, gee, platinum's the hot ticket. So and or it's oil and energy. So now we got inflation because that's in the CPI. Blah blah blah. I mean, this is a huge issue, which and so I'm really glad you brought that up. So Bob, let me just keep moving here because I got a whole bunch of other questions, but I want to bring others into the conversation. Let me just hit on a few other things. We haven't even gotten into your predictions or what you think is going to happen to gold or silver or platinum. We'll leave that aside for 1 second. I'm really interested in the inside baseball stuff that you're talking about. So I just have to ask, if we go back to the Fort Knox situation earlier this year, and everything's like kabuki. It's just it's performance theater, and almost when they go out of their way to say, "Oh, we're going to go and inspect," they make up this. Well, maybe it's not a red herring, Oh, I'm Donald Trump, or I don't mean to make this political, or I'm Elon Musk. We're going to go and inspect the gold in Fort Knox and make sure that it's there. Okay, well, nobody asks the question, but the fact that they're doing that makes me almost think that it's not there. It's like, Bob, if I come over to your house and I say, we're just sitting there and your wife makes a nice meal, whatever, and I say, hey, Bob, don't worry, I'm not going to steal your silverware. George, why do you say that unless you were thinking of it? All right. So like, nobody asked if the gold was actually there, but they're going out of the way to create this whole drama. So a couple questions around that. So one, is the gold there? You may say, well, it doesn't really matter. It claims on gold elsewhere, but is the gold there? And then just one follow up to what you were saying earlier. I mean, the amount of gold that was coming over here was so big. You might remember the first quarter GDP numbers had to be I mean, the story was there's zero hedge for those of us that read that stuff. Oh, the GDP numbers had to be adjusted because of blah 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 and the gold and this and that. Were the numbers so big that it was actually impacting? So, two questions: one, were the numbers so big it was actually impacting the state economic systems? And then two, speak on Fort Knox.
Yeah, no, the numbers are huge. I mean, you're talking what, 36 million ounces of gold, billions and billions of dollars of gold coming into the country. Yeah, and so if you look at this stuff, if you really want to, I mean, the Fort Knox thing was like, to the gold bugs out there, it was like a hard on when it comes to promotion.
So, for those of us that don't know it, that's a technical term which Jilly could explain it later. But go ahead, Bob. Keep going.
Yeah. So basically, talking about algorithms and you want to get maximum effect on social media, just talk about that. So that just like it's like throwing steroids into the gold promotion atmosphere. But the idea behind whether there's gold or not in Fort Knox is actually audited every year by the Inspector General's office. I mean, they don't go in and count every single bar every year. It would take absolutely forever to do that, but they do. How Fort Knox was basically originally when it was bars were counted, then they put uh, uh, these stamps, or not stamps, but they put these tamper-proof seals on the doors, and so forth, so they know whether or not someone's been in there. But the inspector general does do they audit the seals and so forth. And actually, back in 2006 and seven, the U.S. Army actually they pulled out a bunch of metal and did assays on a sampling size of metal as well. So metal has been touched and counted in Fort Knox. The problem is a lot of this metal is not 49 fine gold. It may have been gold that came over from Europe, or it may have been melted down from St. Gaudens and Liberties, and where it wasn't pure gold. It was 90 22 karat gold, that type of thing. And so it's not the traditional form you would think it's in. But put that aside though. To me, that's not really the issue. I mean, if there isn't any metal in Fort Knox and that comes to be, that's the least of our concerns. To me, the big thing is just trying to educate people why to own the metal in the first place. And I keep saying to people, you got to put yourself on the gold standard. Don't rely on the government. For example, when Trump was talking about tariffs and so forth, and the market was bringing all this metal in, the Senate had the perfect opportunity to use gold as an accentuation of the balance sheet, or to strengthen the Treasury's balance sheet by basically saying, listen, we just had all this gold come into New York. We're going to lift the price up as the U.S. Treasury through the Federal Reserve, where we're going to use the Exchange Stabilization Fund, and we're going to peg gold to $4,000 an ounce or $5,000 an ounce, and we're going to create a bid offer where we'll offer it $100 over and we'll bid it $100 underneath, and all of a sudden you revalue gold. But what you're actually doing is you're strengthening the balance sheet of the Treasury. You're not necessarily just moving the price of gold up just to simply sell it like a lot of these politicians do, and just say, listen, we're going to use this to pay a third of our federal deficit next year, and just sell out all our gold. But they never did that, unfortunately. But that was a perfect opportunity where they could actually use public policy to actually strengthen the Treasury's balance sheet.
Why do you think they didn't do that?
Politics. I think the at the end of the day, I think the whole thing was almost, you could think of it as a ruse, because the banks made a fortune on this. They obviously didn't have any problems hedging and taking all this massive exposure as the contango was widening out. And the EFP was blowing up, because really, in essence, in fourth quarter, they were losing money. And then they realized, okay, we got to get the metal. As long as we have the metal that's backing the futures contracts, we can put that metal on exchange and use that for collateral. We're fine and dandy. And 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 that's where, when the administration came out, I think it was April 2nd or 3rd, and they said, listen, bullion's going to be exempted. That's when everything started to cool down very quickly, and it kind of came to be that this whole thing was just, I think, more like you said, theater.
Got it. One more question for me, and then we're going to go to Gnostic. And anyone else wants to ask a question, please raise your hand. Bob, I have so many questions, but let's just go to this one. Could you speak to, for all the folks in the room, if they want to go buy gold from local coin guy or gold guy, or they go to Costco, or they, 1-800 Patriot Gold or the crap you see on TV, whatever. Can you speak to, I'm sure like all these things aren't as legit as the rest. Can you just speak to, even if you go on to a guy who's not a ripoff artist, like the premium you're gonna have to pay, and so forget about the price you see on the screen. It's when you read about in the papers for the individual who wants to go buy gold. Can you talk about some of the pitfalls that they can encounter depending on the avenue they go down?
Yeah, I mean the big one is avoid anyone that has an endorsement. That's rule number one. I mean, if it's Fox News, if it's a famous actor, if it's a famous sports star, if it's the Trump family themselves, avoid that because typically that dealer is going to have a massive markup because they're going to have to pay a lot of more people out of that commission than simply maybe a local coin dealer, so to speak. That and the industry has a bad habit of trying to maximize their commission really at the expense of the customer's best interest, and so there isn't any fiduciary responsibility by the dealer to provide best efforts basis to give them the best price possible. So you have a lot of dealers out there that have been shady, that offered 1.5 ounce odd sized coins made by the Royal Canadian Mint, and they had these 40 to 80% markups where the client will probably never make money on it. And basically it was a predatorial type of practice. I think that it went after the aged, the retirement community and so forth. It's unfortunate that a lot of people ended up buying it, and you're seeing a lot of the fallout from this through the CFTC and the SEC getting involved now, and the states getting involved in a lot of these lawsuits and so forth. um, that's one thing. The other side of the equation is the advent of the online dealers out there. A lot of them, will use puffery, exaggerated marketing techniques and so forth to make themselves look like they're the latest and greatest, or the biggest out there. They're the lowest price, period, whatever it may be. But in essence, if you shop around, you'll find out. One, their spot price that they have on their website is actually not really the spot price; it's artificially marked up. And then two, a lot of their products are actually a lot higher in premium than maybe even a local dealer, your local mom and pop shop. And that's unfortunate. And how they've came to be so big is the relationships they have with promoters and social influencers, and the marketing of, because when you start making more money on these markups, you have more marketing dollars that can continually spread around. And so you don't have any regulation, so the social influencer or the promoter or whoever it may be, the blogger, doesn't have really much in terms of disclosure that he has to provide. He just says this is the greatest guy to buy from, without even.
Oh yeah, so my friend Howard, who I think you know, down in the second row. So if Howard calls him and says, "George, I want to buy some gold or silver," like, what do you tell him? Like, what I mean, aside from calling you, like, what should he do?
I mean, definitely shop around. I mean, on our website, goldsilvervault.com, we have a pricing page with precious metals on it. And so people can, they can use that as a guide if they want to, but that's what we sell precious metals at. So you can get an idea. What we do is we buy from wholesalers and refiners, and we have a slight markup. So you can really see what a little bit above the wholesale market would be versus what retailers are probably selling that same exact product for. So, for example, we had a client that bought $1 million of metal. Recently, we saved them $17,000 in the same product if they would have bought from a big brand name online dealer that publishes
Right. So
on.
right. So let's put this in the terms that people probably we've all had experience with, and foreign currency. So, I don't know if it's a rip off now because no one uses cash anymore. It's everybody always on a credit card. But as the line goes, "Oh, I'm old enough to remember when." Let's say the euro is at parity. I'm just going to make up an example. And you go to the airport and you figure, all right, I'll pay 1%, 2%. Well, lo and behold, you're paying 6 or 7%. So it's 94 bid by 106 offered. It's like, are you crazy? I have a funny story to tell about that later. So it's a complete ripoff. All right. Now it's not so much because a lot of that's been arbitraged away, and plus no one really uses cash anymore. But in the world you live in for physical gold, so let's say gold's 3,300. I mean, bid ask spread. So, like, let's say I go and I want to buy gold from you, and I have to pay a premium of X, and let's say it's 1%, 2%, whatever it is. And tomorrow maybe I panic, I want to sell it. Again, I gotta pay a commitment, the spread. So, what's the spread on simple products like silver or gold? I mean, it's not the euro example where it's 94 by 106, but if you just use 100 is par, what would the spread tend to be?
Typically, anywhere from 1 to 3% is what I typically try to stay within. You have to look at the industry though right now. Back in 2020 to 23, it was very common. Let's just take silver for example, that people were paying 6 or 8 bucks over spot for a 1 ounce sovereign product like a maple leaf or a philharmonic, and then they were paying $20 over spot for a gold eagle, which is almost 100, or a silver eagle, which is almost 100% premium. What's happened now is the industry has, the profit margins have completely imploded. They topped at the end of 2022. I was on Spaces talking about it then, and what you're seeing now is how the industry is surviving is on people selling back. The discounts, the spot right now on a lot of these dealers out there for silver, maybe as much as 8 or 10% under spot. Gold may be 3 or 4% under spot. For just typical gold products out there. So what they're doing is they're buying back at these really big discounts, and then they're trying to sell this product to the public with not as much of a markup. The 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 issue you start running into with all this is it's the cash flow or the amount of activity as this market has been rising in price. The transactional business has actually been in decline. A lot of people think, well, God, gold's going to be at the top because the retail is just probably around they're around the street corner lined up trying to get to buy gold. In fact, it's just the opposite. Since end of 2023, the retail public has actually disengaged and has been selling metals back to the industry, not buying, which is very, very odd. And it's one of the reasons back in 2023, I was at the Silver Symposium and I spoke and I said, listen, this is what I think is going to happen is this is when the price was at 22. And I said, what's going to probably happen is the price is going to take off. No one's going to trust it because they've listened to these promoters and the gold dealers talk about how everything's manipulated and the banks are just going to smash the price back down and it's never going to go anywhere because there's all this sort of this invisible hand over the market. But what's happened is people.
Taylor, you still there?
I'm still here.
Sorry about that.
Hey, yeah, yeah,
Yeah.
Bob. Hey, just wind back 5 seconds, please.
Okay.
Bob,
Yeah.
just go back 5 seconds. Yeah.
Okay, so basically, as the retail has been selling into the market, dealers have been taking on a lot of metal, and they've been cash poor and inventory rich. And part of this rise in the market has actually been dealers actually, because what dealers do is they go in and then they short the futures contracts or they'll hedge somehow their physical inventory because they're all working on lines of credit. And so what you started to have was this sort of melt up in price, but driven by the futures markets, not necessarily by the retail market that's out there, mom and pop buying gold, hand over fist. That's actually not been happening. And so the dealers have been actually been getting, when the tariffs started to take off, a lot of the dealers were actually losing money because they're sitting there with physical inventory that they're hedging, but now all of a sudden their futures or their hedge is rising faster or going in the wrong direction
I
fast,
got it. Yeah. Yep. So they're getting hosed. I got it.
and
All right.
and their financing costs have been rising as
Yep.
well.
No, I get it. I get it. I get it. I get it. All right. Last question. I really want to get Gnostic in here. I can't. You'll know the name of the company. It's escaped me. My it's a senior moment. What's the name of that publicly quoted company that most of their businesses they're like a they had a bunch of retail gold stores. A Cuppy was humping the thing a year or two ago. Do you remember the name of it? Maybe Gnostic. You remember the name of it? It's publicly traded. I can't remember the name of the company.
Oh, a mark.
Yeah, A-Mark.
Okay.
What happened to that thing? Is that done okay? I hadn't even paid attention to it.
No, no. Amark is really the behemoth of the entire industry. So they're a great guide of what's happening. Their stock has just imploded. It's near the 52-week lows. It just
Are
bounced.
you wait. I'm sorry. You got me going now. This is I love this type of story. It's like, Gnostic, you know where I'm going with this, okay? It's they just keep it simple, stupid. Like, you think gold's gonna go up, buy some gold. No, no. Gnostic, if I could show you a really clever way where, instead of gold going up, 20, 30%, you're going to make 100% and blah, blah, blah.
Oh, I have
So
a
you had
good
the
deal.
right.
I have a deal for
I
you,
no,
George.
yeah, Gnostic. Hold on. I want Bob to answer the question, but I was definitely trying to trigger you, right? So it's like you have the right idea, Bob, but you choose the wrong instrument, okay? And I swear to God, it was like Cuppy was. I love Cuppy. He's a friend. He was pumping this thing. It's only on 5 times earnings and blah blah blah. It's like, what could possibly go wrong? So, Bob, what went wrong?
The profit margins just imploded. And I had talked to I on Twitter. I was commenting to Cuppy that you got to be careful within the industry because the profit margins were, they had never been greater than they were in 2022, and everybody and their mother jumped into the business, and everybody was taking inventory, and Amark is a great company, but what they did was bought they bought a lot of retail dealers. They also own mints or private mints and refiners and so forth. So they kind of grab the entire spectrum of the premium of the product, from the wholesale all the way up to the retail. But the problem is, I think they didn't see the decline in retail activity, and then all of a sudden the distrust that the
Mm.
retail public has for precious metals, and they started selling back, and that's what imploded not only them, but a lot of other players have been impacted as well.
Oh boy. All right. With that, I'm going to give it a rest briefly. So, Gnostic, over to you.
Hey, Bob, nice to see you.
Yeah, good talking to you.
You've come a long way in figuring out how this stuff works since we first talked. I'm really I'm very happy for you. Very proud of what you've been able to sit down and pull down, and the understanding that you've gotten in the market.
Sure.
The and George, well, this is a good guy. Um, I vouch for him anywhere. Uh, if somebody's gonna hold your gold, I would I would recommend Bob. But Bob, here's my question for you. You were looking at shorts on silver and gold earlier, and have you come to any conclusions about all of the shorting that's been going on, and whether or not it's actual shorting or commodity shorting or base shorting or naked shorting? Um,
I,
what's your feeling
I
on all of that?
I think in the metals markets, I think it was market makers that were short, the proxies, like the SLV and a lot of these other ones out there, because it was just too expensive to get the physical at the time, and the lease rates were high enough where they could then you know make a synthetic product, I guess you could say, by using their own inventory and and basically shorting the shares and trying to capture that because what was happening was the borrowing fees started rising because lease rates were rising on actual physical silver, and so you saw this explosion in borrowing rates, for SLV, or PSLV, I think it was, or a lot of the ETFs. You started to see that, and I think they were just grabbing that revenue, of loaning out those shares. So it's and I think, the equity players never really went into that type of marketplace before because you never saw the blowout in lease rates as fast as we saw it. I mean, you were talking platinum lease rates were 16%. You were looking at silver was 8%, gold was 6%, and these were very, very short term rates. And so it was very lucrative, to take some type of synthetic position and start loaning out the actual, because people were buying SLV instead of buying the actual physical silver. And so and the short interest went from 20 million shares short on SLV to like 68 million shares short on SLV during that 3 month period. It just exploded. So that's also sort of this. I think that the authorized participants or the market makers, they're sort of hand into the business or into the commodities markets where they actually have, sort of a management control over the overall price action of the physical metal, because the physical metal is just tiny compared to all these derivatives. And we can get into Basel III, and why the banks are trying to push off a lot of this exposure of trading activity onto regulated exchanges and away from their balance sheets and that type of thing as well.
So that which leads into a follow-up question on that, and that is, what's the actual issue for gold, Basel III, and the banks? Like right now, I think it's 50% they can hold on their balance sheet, and under Basel III, they run it up to 100 or something. And is that the case, or is that different?
No, Basel III was, which is, and I kind of explained this when it first came out in 2022, was more about funding requirements. So in London, you have, to make it simple, you have allocated accounts and unallocated accounts. So let's say you're a bank customer, you want to own gold. The bank goes to you, listen, you could have door number one, which has no storage fees attached to it, and and you can buy gold, or door number two is it has storage fees attached to it, but we hold the gold for you on your shelf, so to speak. So a lot of it used to be in the case where people would choose door number one, which is called unallocated products, where the gold is actually backed by the bank's balance sheet, not by any gold. And so the banks may go in and they may buy options or futures or some sort of structured product to give a resemblance of gold. Whereas what Basel III did was said, listen, you can't just simply issue an unallocated type of product anymore without posting 85% of whatever the client buys. That you have to post 85% of reserves against that. That you can't just use your bank balance sheet anymore, because Basel III was really trying to reduce balance sheet exposure and reduce leverage in the system. That's basically what it is. There's the idea of tier one capital and so forth, but that's and a high liquidity asset. But gold isn't deemed that, because there's one caveat, and I did a whole Twitter piece on this thread talking about HQLA and so forth, high quality liquid assets, and why gold isn't part of that, because there's one section that it doesn't meet the requirement for. But Basel III was mainly more about leverage, and if the bank actually uses gold and puts it aside for the customer, then there's no reserve funding required.
But let me just ask a question here on that. So we have a fractional reserve banking system. So the result of that being, if everybody went to the bank at the same time and said, "Give me the money," it would be a problem. As far as gold is concerned, let's say people came suspicious of the ETFs and they became suspicious of the Fed and the Bank of England, all this stuff, and everyone decides, "Oops, I want my gold, and I'm going to bury it, under the floorboards in my house. I want my gold." Do we have kind of like a fractional reserve system for the gold? Like all these people think they own X amount of gold. Does that amount of gold actually exist?
No, because most of it's derivatives. The derivative market trumps the actual physical exposure, because the physical exposure is just leveraged out. And you have to remember, they use the market makers and so forth will use different structured vehicles, options and futures and swaps, and they'll use deferred swaps and all these types of things to give resemblance of the actual metal. But at the end of the day, that's why if people just took delivery of physical metal, if an institution just says, you know what, I'm just going to buy this metal, I'm not going to store it in New York in one of the COMEX custodians, I'm going to pull it out of the system, bury it in my basement or store it
Right.
in a facility outside, all of a sudden you've just taken away a lot of leverage factor that the system actually uses to give the sort of the illusion that there's plenty of metal out there. And that's
So would that jack the price?
Oh, it would, yeah, because all of a sudden you would have people that thought they were fully covered or fully hedged. All of a sudden, that hedge may blow up right in their face, like we just saw with earlier this year with just the talk of tariffs, and all of a sudden you had, gold's EFP go double in price, and you had people that were seriously going underwater very quickly, even though they were long physical. Their short position was just going completely against them. And that's one of the reasons. This is what I saw back in 2006 to 2008 when I was studying all this stuff, and I was like, Goldman Sachs and all these banks were leveraged 50 to 1, 25 to 1. And I was like, this is not going to end well. Just
Right.
and the same thing can happen in the metals market. That's why, what ultimately could happen is you could have a shift. And I think what Basel III is doing is it's delevering the physical metals markets, where people have been going more towards physical and away from these structured products. I think there's, and they're doing it to avoid or reduce enormous amount of risks that are associated with obviously these structured vehicles.
So one more question back to Gnostic. So I know from energy, talking to Mike Rothman, we had him in the conference the other week, but I've learned over the years, he explains that the financial market, the paper market for oil, is 40 or 50 times the size of the physical market. So, you might think, well, gee, the way to calculate to try to predict oil prices is just go around and count barrels. No, the financial market is so much bigger that if the hedge funds get all bared up, let's just say they think the recession is coming, blah, 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 as was the case earlier this year. It doesn't matter if the physical market's tightening. The oil price is going down because the speculative demand for oil, everyone's placing their bets in your head. Like, it's kind of funny almost. I mean, you had almost like record amount shorts in oil just before the price spiked the other week. So, but the question is, yeah, is there a question? The paper market for oil is 40 or 50x the physical market. Do you have any numbers off the top of your head? Is there anything analogous for both gold and silver? Is it, I imagine the paper market's much bigger than the physical market, no?
Yeah, it is. I mean, if you look at the COMEX, for example, trading on the COMEX, only about 2% of the trades actually get um, physically delivered. If you go to London, London's even worse, because I think it's like 100 to 1 in terms of, because in London they have these contract for differences, CFDs, that trade in London, that
Oh,
are
God.
heavily levered. They're not even allowed to be
Yeah,
traded in the U.S. because they're that
yeah,
levered.
yeah, yeah. No, I know, I know,
and then
I know.
you have Europe, in their bright idea back in the 90s, created this UCITS situation, where all of a sudden, uh, basically it's UCITS is what they call it, undertakings for collective investment in transferable securities, which basically says we don't want institutions owning anything physical. We want them owning derivatives, because the banks can provide a lot more liquidity to a derivative than they can the underlying asset itself. That's how insane this whole thing is. So
Oh, God.
yeah, so that's one of the reasons why the metals really never go sort of AWOL, because there's a massive amount of control to keep everybody in the corral, so to speak, in the paper instruments.
Yeah.
I mean, this is how small this market really is, and I noticed this back in '06, and I'm like, I got to open a depository. I mean, there's no way to guard against the risk that if you own SLV and all of a sudden this stuff starts to unwind and silver goes through the roof, you could have the ETF sort of implode against you in a way, because one, it may not be able to get any metals, or two, the authorized participants may not be able to provide the type of liquidity that's needed you know to support the trading activity that's going on within the ETF.
Yeah, we've that's been the type of thing people warn about, but up till now, it's like the little boy that cried wolf. It hasn't really mattered, but you're right. And in that scenario, you, again, go back to the example, Dilly bought the silver ETF, a gold ETF, because she thinks the price is going to go up. And yeah, she made the correct underlying decision. She's bullish on gold or silver, but she chose the wrong instrument, the ETF, just in the same way buying, sorry about that, just in the same way buying AMARK was the wrong decision. So, oh my head's exploding. Let's just
Well, well,
sorry, go ahead.
well, if you take it to the next level, or the next tertiary level, if you own GLD and you sell it, you're still in paper assets at the end of the day. You're not diversified away from the system. So all you're doing is just trading a
Right.
representation of gold, or the price representation of gold, back into a deflating fiat instrument.
Fair. I got more to say on that, but I'm going to let Gnostic jump in. Gnostic, back to you.
Thanks.
Gnostic.
Yep,
Yep.
I
Go
got
ahead.
it. But just have
Yep.
I'm all thumbs. Have to find the speaker
Yep.
button. So, Bob, question for you then. It sounds like what you're saying is gold in its various forms, including derivatives, is a spectrum market for investment, with minimum risk being self custody of one sort or another, either storage or personal under the floorboards, and the other one being other end of the spectrum being a derivative or second derivative of some sort, and that spectrum risk is something that should be evaluated relative to the individual investor and his current ability to take risk. Does that about sum it up?
Yeah, and if you're doing storage, let's just say you choose a professional storage company or structured program, what you want to do is have a direct relationship with the depository itself. You don't want to have a situation where there's a counterparty between you and your metals, and the counterparty actually has a master sub relationship. So therefore, you call the depository up. Let's just say you had COVID happened, everything hits the fan, and you go, I want my metal. The guy that's the middleman doesn't answer the phone, and you call the custodian. They go, who are you?
Who are you?
So it is important to have what they call directly held. That's important. And then of course, I counsel everybody, read your user agreements, read your storage agreements. There is a litany of phrases to watch out for: limits of liability clauses, hold harmless agreements. You're starting to see more of these waiver of jury trial clauses, waiver of class action status clauses being put into these contracts. And now they're not even being put into the contract. In the contract, it's just saying, listen, we have the right to make an amendment or addendum to the contract, and we can post that on our website, and that's good delivery of notice. So now you're starting to see these waiver of jury trial clauses just show up on the website. That's actually, a legitimate change to your contract.
Oy, oy. Hey, so Bob, whether it's hold on, Nasser, whether it's so let's say I want to buy an ounce of gold, okay, $3,300 or whatever it is, all right, and okay, so you don't if you don't want to talk about your own company, you can talk about there are probably some other dealers or some other depositories out there who do what you do. We have high regard for it. But let's just talk about yourself, okay? So I call up and I say, hey, Bob, I want to buy an ounce of gold. I presume you can. I don't know if you tell me to. I can buy it through you, or I should buy it through somebody else. But so A, who's going to buy the gold, and then B, if you're holding it for me, like what does it cost per year to have the gold held in the storage at your place?
Yeah, the storage fees is we have it on our website. There's a breakpoint schedule similar to a mutual fund, where the more you
Okay.
store, the lower the fee drops. On the gold side, just however much gold you want to buy, we put the prices right on the website, so therefore you can see exactly what we charge. And if the product isn't there, just call us up and we can give you a quote. Because I can get products, I can get pretty much every product out there. But
Hmm.
try to be transparent. That's what I try to be. So therefore, the client doesn't have to go through this sort of jungle process of trying to locate the storage agreement, trying to locate the storage fees. It's all on there, and in the storage agreement, you can read right through it. You'll see the exclusions. Like for example, for insurance, that's another thing to go through is understand the exclusions. Mysterious disappearance is one of the most common forms, besides insider theft. Mysterious disappearance is one of the most common form of losses. We actually have an exclusion on that policy, or not. We actually cover.
Wait. Mysterious disappearance. What? That sounds like a real euphemism. What is that, please?
It basically, mysterious disappearances. Let's say I go into the vault, I'm doing an audit. All of a sudden, I pick client A's box to do a full count, and all of a sudden, he's just missing two gold pieces for some odd reason. No one can really explain where the hell did this gold go. Well, that's what you call a mysterious disappearance. So we actually cover that within our policy.
Hold on. Gnostic bought the gold. He said you store it for him. Okay. What do you mean, Mister? Not you, but the clowns across the street who have this clause. What do you mean the gold disappeared? Like, what are you talking about? I gave it to you. Like, why should I let the schmuck across the street who's competing with you? Why should I let him off the hook? It's like, what kind of crap is that?
Well, you let them off the hook because probably they had a waiver of jury trial clause that you signed it when you signed the agreement. You didn't
Yeah,
probably.
but who with any conscience would even put something like that? That's insane.
It is, and that's why you have to read this stuff. I mean, there are programs out there that have such stringent limits of liability that basically you have to go through hoops just to try and get to them. And even if you win all the hoops, their maximum liability is $10,000. Even if you put 100 grand with them, I mean that. Yeah,
What?
that's how bad this industry is. And I'm one of the few guys that publicly talk about this on Twitter, and I want people to be educated because most of the time the marketing sounds great, but the marketing is it's just marketing. It's puffery. It's designed to kind of draw you in. But
Ay, ay, ay.
yeah,
Ay. Gnostic, back to you.
George, I'm going to have a problem phrasing as
You broke up, Gnostic. You broke up on us.
that. I'm getting an annoying phone call.
Yeah. Okay.
Yeah, I know. I'm getting a.
All right. So Gnostic,
I'm
go
just
ask the question. Ask the question. I'll rephrase it if we can't understand what you're saying. Go ahead.
okay. I'm just laughing too hard at the moment at your
Yeah.
astonishment of reality. Uh, Bob, so I just came back with a joke from our previous conversation. What you're saying basically about the risk and the risk allocation stuff is basically if everybody stored their gold with you, you'd cause a financial collapse of the gold system. Is that about accurate?
That's accurate.
Okay. Next question, Gnostic.
Oh, come on, George, you got to appreciate that one. I mean,
No, you're no, but Gnostic, you're 100% right. You're
Bob
100%
Bob
right.
is Bob is structuring the collapse of the financial gold market. You know, in Europe, North America, all the rest of them. We just have to store enough gold with them that it screws the rest of the system. No more
Well,
derivatives, no more this, no more that. It's like,
yeah. Well,
wow, gold will be at
yeah.
$20,000 an ounce. Bob, thank you.
Yeah. Yeah, well, Nasser, hey Bob, are there other guys? I mean, are there? I'm sure there's some. Is it hard if they don't? Other than you, are there other guys out there who do things similar to you? Or are they far and few between that? Give the customer an honest shake like that.
I honestly don't know anyone else in the industry set up like me, and I can say that because I think I'm the only registered investment advisor that actually does this and owns a depository and buys and sells metals and that type of thing. But more importantly, I don't, unlike the industry, which again, when I started this whole thing, most depositories are actually owned by or affiliated with the gold dealer, and the gold dealer uses the depository as sort of a carrot to grab the transaction. So that it's really the transaction is where they make their bread and butter. I'm the exact opposite. I mark down these products very, very minimally, and the storage fee that I charge is extremely competitive. And I know what it takes to actually protect people's money, not charge them this, a very minimal storage fee that really is just a disguise,
Sure. Yeah.
to grab, the money out of their
Yeah.
back pocket.
So, Bob, you said you had how much
Can
in
I?
storage? 800 million. Is that what you said?
Yeah, yeah, yeah.
And how's that grown over the last 2 years?
It's done well. I mean, we've been increasing it 100 million a year. But it's probably a little bit more. We'll know more in the next 2 weeks when we do our quarterlies, so that we'll probably increase the policy coverage and because the problem I run into is the price of metals are so volatile that these prices can move 10%. In a week's time, especially depending on what missile hits which country. But for the most part, we've been growing organically. I'm not out there, paying all these promoters and bloggers, high price, fees so I can charge these excess commissions, to support this marketing program. It's really a grassroots effort.
All right,
So can
so
I step in here just
yeah,
for a
Gnostic,
second, George?
yeah, Gnostic. Hold on. I
Okay.
was going to recognize that. I just want to set the order here. Gnostic with a follow up, then Carpathia, then Howard. Gnostic, back to you.
Okay. So Bob, aren't you an accountant by trade?
Well, I'm a registered investment advisor, so
Okay.
that's
So
and so and
hold on, Bob. Let me finish. So I don't think you have much of a speculative bone in your entire body, which makes you different from most people that are doing this. Because I've had conversations with you and offline. Uh, he knows who I am actually, George, and I don't recognize you as being speculative at all. So you're actually trying to run a business and not set up a speculative fractional type banking system for yourself to sit down and make money on the side. So I'm well on one side, I'd love to be able to speculate with you, but on the other side, it gives me great confidence that you're not trying to speculate and make money on the side for different things.
yeah, what I do is build relationships. I'm old school. I learned this back in the Quotron days. It's not about how much you can it's how much you give the client and how much respect you have for the client. That's the loyalty that I have. I never marked this stuff up big in 2020 to 2023, where I could have done it like everybody else was doing it. No, I wanted people to have the opportunity to make money in this asset class. Unfortunately, the industry did such a poor job between those years that I think it scarred a lot of precious metal buyers from coming back into the market when they realized how much of a markup they were. There was so much crap going on. There was this idea of shortages of silver, but in reality, what was happening was just simply tightness in the production of certain products. It wasn't a shortage in the overall silver metal itself. And that, but in this industry, you don't have compliance, you don't have regulators that are looking over your shoulder like you do in the securities markets.
Thanks for that. All right, Carpathia and then Howard. Carpathia.
Good afternoon, George. Great job on these. Thank you.
Well,
Bob,
very
you and
welcome.
Bob and I have communicated a little bit, over the months, and I think I would second Gnostics, but I probably am going to ask a question he just answered, and then I'm going to ask him to comment on a thesis. What is your main reason why high net worth retail, the family offices, I just saw stats like they're under 2% precious metals, or even smaller, or commodities, and it's probably what you just answered. I just am a little I'm behaviorally finance and very intrigued because my physical and my paper is performing fantastic, yet nobody wants it. Nobody is interested. Do you think what's your primary thesis on that? And you probably just answered it before I asked that question.
No, it's a great question, because what's been happening since almost 2019 is that high net worth investor, and really since 2023, when the metals really took off, end of 2023, early 2024, is when really the high net worth investor that had absolutely no metals whatsoever started to see, okay, prices are going up. It started to attract, it's like a moth to the flame. It started to attract attention. They started to get inquisitive. They probably heard the story a million times, but there's nothing like price to attract more money. And so ultimately, the big high net worth investor has been the one that's been buying the metals, while retail has been selling. That has been the mantra since late 2023.
Okay.
But I think the issue is, um, some of these high net worth investors, if they're, especially if they're family offices and they're kind of regulated, or they do filings and so forth, metals are not a security. So it's an odd asset to own when you own it just individually. And then the question is, where do you own it? People look at safe deposit boxes in a bank. There's no insurance on them. They may look at, depositories, but then they go, well, why should I pay a storage fee to just keep it in the ground? Why don't I just store it myself? And then they realize they can't store it at their house because the cost to get a rider on an insurance policy is more than what it costs to actually store it at a depository. And then, of course, then they look at outside foreign entities, maybe store it outside the country. Then they realized all of a sudden, like when COVID happened, and they were in Singapore trying to get to their metals, and Singapore said, you know what, you're going to have to sit in a hotel room for 14 days before you can even enter the country. That turned a lot of people off, and then they started to realize, well, I got to send this stuff back to the U.S. because this idea of not holding all your eggs in one basket doesn't make sense anymore. And then they started realizing the logistics costs of moving it back into the United States is more expensive. And in some instances, a lot of these structured programs are just raping people. One guy that had, I think it was like 5 gold ounces. One of these companies wanted like $5,000 or $10,000 just to ship 5 ounces of gold. People are being trapped in a lot of these programs. And then, of course, then you have these filing requirements that people may not be aware of with the IRS. If you store your metals outside the country and it's directly held in a safe deposit box, you don't have to report it on Form 8938 or FBAR. But if you actually store it with a gold dealer in a quasi depository account where the dealer has an insurable interest in the metals, now all of a sudden that's an exclusion and you have to report it. And if you don't report it, it's a $50,000 a year fine for every year you don't report it. I mean, there's so many nuances that most of these investors just aren't aware of, and that's what I've specialized in. This is my bread and butter. I'm like the Jerry Maguire of the gold industry in a way, because my job
Thank you for that.
is to try and protect the customer, because at the end of the day, the relationship with the customer is the most important thing.
Thank you for that. And then I would like you to comment on my thesis. And the thesis is it's complicated for people to understand. And what I mean by that, the reason my family office owns a pretty significant there over the years is because of the monetary wave aspects, the debt levels in the Western world, and the gold is promoted and precious metals are promoted as, oh, there's a geopolitical event, this and that, and end of world. Well, I'm getting up there in age. I'm not quite as old as George yet, but I'm trying to chase him down. And there will be a time I'm not going to die with this. I'm going to use it for something, give it away, or what have you. I don't want the kids, look at grandpa, and what do we do with this? I think there's a misunderstanding of why you want it. I think people, they get visions about Armageddon and these different things, and you can't eat it, just like real estate. It's a monetary hedge for based on events that happen every 80 or so years. I'm listening to the book, 13 hours or 13 whatever, the Camp David, 13 hours at Camp David or something, when Nixon took us off the gold standard. So my thesis is people don't understand that it's a monetary event, and it takes 2 and 3 levels of degrees of thinking about history, and you have to know, you don't have to be an expert. But I'm really glad I own some, the past 10 years, 15 years. Yeah, we have drawdowns, but it's nice. And is that a bad thesis, that it's hard to understand and people wrapped with these things you're talking about, it just turns them off? But the high net worth people do. They do get it to a certain extent.
Yeah, it really is an insurance policy. I tell high net worth clients, think of it as taking chips off the table. You made your money in the stock market, or you made your money, with your small business or whatever it may be, and now you're taking 5% off the table and saying, listen, they can't take this away from me. It's like taking the chips off the table at the casinos. That's similar to what I think the metals kind of represent. The problem I think we've run into is the crypto and the Bitcoin and so forth, is this allure of chasing performance, and the idea of the Michael Saylor on steroids, where all of a sudden you just got to leverage up and buy as much as you can, and it'll be a not even Hunt Brothers 2.0. It's more like 5.0, going into leverage. There's no way this guy can get out of that trade, but it doesn't matter because the price just keeps going up, because that's all we hear. Unfortunately,
I think they're going to bunker hunt him eventually, but that's my opinion. Go ahead.
yeah, but the the advantage of the metals is it's been around, millennia. I mean, it's this is something that the entire world does recognize as a store of value, and that's, to me, that's you keep it simple. That's
Yep. Thank you so much. And I'll give one last piece of advice to the room. Take a deep breath. I prefer the square bars, because if you use the rounds, the 1 ounce rounds, and it rolls away from the border guard, it pisses them off. That's a joke. Bye.
I always tell clients, you can't take your Charles Schwab statement to the border to get across the border.
Thanks, Bob. You're muted, George.
Howard, you're up. Please unmute yourself, Howard.
Hey, George. Thanks very much. Hey, Bob. Good to talk to you again. It's been a while. This has been about the best metals rundown I've heard in quite a while. And I actually I gave George a nudge to do this, or he gave me a nudge asking about.
No, Howard. It's your fault. You get the credit for
Oh,
this.
it's my fault. Okay.
Yeah, come on,
And
come on.
part of the reason I did that is that I'm getting a lot of noise from. I have various friends that have, anywhere from, say 1,000 ounces of silver to several tons, but they've bought it for the reasons of the COMEX seizing up, and the wild speculative stories they're hearing on YouTube and in social media and so forth. And so one, thank you, Carpathia. I saw that exactly. And I just thought, maybe you could come on and do exactly what you did today and give the real straight story. And I want to, you and I have talked offline about various things, and I wanted to reiterate what Gnostic and Carpathia have said, because I've looked around for storage. I've looked around for knowledgeable people. I've looked around for people who aren't on three sides or four sides or five sides of the market. And I just want to reiterate everything that both of them have said about you and what I've seen. I'm nowhere near at their level. And I'm going to ask you a question about a different end of the market, which is, are you seeing in the Rockies, are you seeing much more family, artisanal, and small scale mining actually producing? I've looked at mines up there for years. I've talked with various people and come close to making arrangements on a couple of these things, with non-cyanide leach operations and so forth. And the putting it together isn't that difficult, but I'm just wondering if we've seen the prices of the claims go up some, prices of patented claims go up some, but it's very hard to tell from the brokers and so forth what it's very hard to get a real read on the market. And I'm curious, because you're in storage, if you're seeing anybody in particular really producing. And then, George, if you've got a minute afterwards, I've got a funny under the floorboard story that people might appreciate following on Gnostic's under the floorboards storage option. Thanks very much, guys.
Sure. Yeah. The artisanal mining and so forth. I think investors, it's a difficult business. A lot of times you talk about the word leach in terms of separating gold from the impurities. Well, investors typically get leached, separating their money from their wallet in a lot of instances. It's a very difficult, especially on the smaller mining side, because there's just almost like an unlimited amount of capital that may be needed to keep these things afloat. And then, of course, you got the volatility of the price and so forth, and the struggle of trying to maintain consistency in production and so forth. So, I don't. I've always just told people, if you're going to go into the metals, mining and so forth is more of a speculation. Going into the physical is really just part of your portfolio and should be looked at more as like the insurance policy. And unless we figure out a way to curb deficit spending and this runaway debt spiral and debt cycle and all that other kind of stuff, I think there's only one way is to basically inflate our way out of this mess, and that's obviously one of the reasons why metals are a great hedge.
I'd concur, Bob. It's nobody's liability. It's more the mindset before you buy it. If you're going to the hot craps table, trade Bitcoin, do all that, but it's really your mindset. And it takes a little bit of the time to read some of Judy Shelton's stuff and read some of the monetary aspects of it. And then you'll be much better. And then just don't go whole hog. Well, occasionally the carp goes whole hog, and then
Hey, 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 hey. There's
what?
nothing wrong being whole hog carp. Come on.
I'm pretty barbelled.
All right, all right, all right, all right. Howard, do you have a quick follow up, and then I got a couple closing things I want to say.
Yeah, I do. One reason that I started looking at and talking to Bob about storage is that a friend and customer of ours out here, not in Pebble Beach. His mom lives in Pebble Beach, but he's over the hill. He's got a big place, and he thought he built perfect storage and hit a giant safe behind a pantry. Left town for a few days, had to go into the hospital. Comes back, and basically the wall of his kitchen is gone. Some guys figured, I don't know how they knew that the thing was there, because he did most of the work himself. But they literally they sawed through the wall partially. They chained up to the thing, and they used a tractor to tow the thing out of the building and then load it up and take it
What?
away.
Oh my god! Oh my
So,
god!
and
This is
that's
good.
here,
This is
right
really good.
in Los Gatos or Los Altos Hills. I forget exactly where that is over there, but it's like practically a large acre lot
Sure.
neighborhood, a neighborhood, not a place like Carpathia that's with real ranches. But real quick, rockhounds will do anything to get at the rock and lose money their whole lives. And a friend of mine that first taught me about looking for deeds. This is 30 some years ago. He's looking up in Last Chance Gulch. He has a couple of claims up on Mount Helena. Last Chance Gulch, up from old Helena, Montana. And he finds a claim, and it happens to be under an old house. And so he leases the house, and he literally cuts the floorboards out of the bedroom and starts to, because that's the access to the shaft, and starts working the mine and pulling gold up and silver up from the bedroom and starting to work it in the kitchen. And so
Wow.
I don't know what the status was when the guy got his house back, but some of these guys will do damn near anything. And
Jeez. Just
those of us
crazy.
that like financial assets are constantly amused at some of the stuff
That,
we see.
that's a great story.
Thanks, guys.
That's,
I really
yeah,
appreciate this.
yeah.
This is a
Thanks so
great
much.
space.
Yeah. Hey, Bob. You know what's really amazing. Thank you for the kind words, Carpathia and Howard. It's amazing because we had the Tesla space the other day, and people really liked that, and because it was noteworthy for the fact there was no screaming and yelling. You know what's wild about this space? Just occurred to me. We've got almost an hour and a half, and we haven't even talked about. We kind of this is bass backwards. We haven't talked at all about the normal question would be oh, so where do you think the price of gold is going to go, or where's the price of silver going to go? They were going to ask that question, but Bob, that's what we're going to close on. And whether you want to answer that question or you know what, I'm a sports guy, so let's put it this way, Bob. So I just want to I mean, listen, trying to make single point predictions is fool's errand, right? But I want to calibrate your bullishness. I want to take your temperature. So if we're in Vegas, so gold's like what I don't know, where are we? 3,300, wherever we are today. Okay. If I said to you 3 years from now, so forget about next week, next day, tomorrow, next week, whatever. But if I said 3 years from now, in other words, or 2.5 years, so end of 27, let's say 2.5 years, all right. Over under, let's say gold 5,000. So 50% in 2.5 years. The Bitcoin people probably look at that and say, that's not enough. It's only 50% in 2.5 years. I mean, what the hell? Would you take the over on $5,000 2.5 years from now or the under on gold?
I guess the question is what happens in the Middle East, but I guess if I would think based on some of these reports that I've read, probably the over. I think that's there's a strong case to be made that I think this whole thing is just going to end up hitting some type of crescendo this decade.
All right, and if we wind the clock back a week ago or a few days ago before the Mideast things started going en fuego, literally, would your answer have been different?
Um, I think it wouldn't have been only because the reading some of these reports and seeing how underinvested a lot of these institutions are in the metals, and you see this. You have to remember we have a big push now by the administration to do these stable coins, and just for I'm going to be going to a stable coin conference here in Idaho actually this week, and talking about the idea of actually using silver to back a stable coin with. And so the stablecoin era hasn't even touched on using physical metals. I mean, there's a couple of them that are using physical metals, but not to a degree of actually buying actual physical, storing it outside the system. I believe Tether has, some type of gold product, but that's all stored in Switzerland somewhere. And there's caveats to that and all that kind of stuff. And there's caveats obviously regarding Tether and their financial audit or non-audit, I should say. But you know, imagine the precious metals starting to be used as a stable coin on a large scale basis. You could run the market very easily.
Got it. All right. So just quick, because I do want to close the space. So, Bob, again, we're not going to quote you on this, but is there a chance? Yeah, there's always a chance, but is there a not insignificant chance, whether it's 5%, 10%, that the price of gold and of course silver along with it, the price of gold goes to some stupid number that you wouldn't want to say in public because people are going to he's totally lost his marbles.
I mean, you could have where basically, I mean, part of the risk mantra that I looked at was social chaos. You look at a breakdown in society, and then also just a whole degree of loss of trust in the political system. I mean, you have that happen. Gold at $10,000 or $20,000 an ounce. Does that really mean anything anymore? I mean, lead will
Yeah,
be worth
yeah,
more. So
yeah. I'm with you. All right. So quickly, Carpathia for quickie, and then Gnostic.
Real quick, from bottom to top, it's cycled 8x. 71, the book I'm reading, Camp David, and then it 8x from 2000 to 2011. So if you use the 15 low, give or take a couple $100, 75 to your template, George, 75% between 5 and 8 in 3 years. And I can
wait. So hold on, just to understand. 75% chance we're between 5 and 8,000 3 years from now. Is that what you said?
that was your template, right? And
Yeah,
I
no.
don't,
But you said
and I don't
75.
care what people think
No,
of me. So
Carpathia.
yeah,
I just want to understand. You said 75 means 75% chance. Is that what you're saying?
yes, I
Okay,
would say
got it. Okay,
75 to 80, 5,000 to 8,000 within 3
got it.
years.
Okay, got it. Okay. Gnostic, as has been the case a lot the last couple of months, you have the last word.
Oh God, here we go again. Okay, so here's the grenade, George. You know I always somehow have a grenade by the
I
end
can
of the
always
stuff.
Gnostic. I can always count on you to stir the pot. Go for it.
Okay, here's the pot stir. Bob, does the price of gold actually give a crap? Is it really important to the type of stuff you're doing, or is that just a straight gamble shot?
Yeah,
Because I look at the way I look at this is what Bob's doing is giving you a savings. And by the way, I get nothing for what I'm saying about Bob. I've dealt with stuff before. I just have a great deal of respect for what he's doing, how he's doing, and the lack of speculation involved in what he's doing, and the counterparty risks that just aren't there. So I get nothing for saying the good stuff I'm saying about him. Believe me. But the other side of this is essentially what he's doing is he's setting up, here's your savings account to sit down and save it. Do you really care what the interest rate is in your savings account? Do you really care if it's going to go up by 5, 10, 20, 50% across X amount of time? Yeah, of course you do to a certain degree, but it's your frickin' savings account, for God's sakes. It's not the money you're going to go and spend. It's not what you're going to live on. It's what, if all hell breaks loose and it goes to whatever, this is what you're going to. So does the price really matter to the stuff you're doing, Bob?
no, I mean, for the most part, it's a return of your money rather than a return on your money. I think that's, you look at the hyperinflation of
Exactly. Yes.
the Weimar Republic, and people were buying buildings for 2 gold ounces. I mean, that's how much money deflated or actually inflated away, became worthless. I mean, so that if you want to look at real, because I look at relative values, and I think silver and platinum have a lot more bang for the buck than gold does, and I think you're starting to see this broadening out of the market, where I think the white metals have been starting to take the lead from gold, and I think silver could really outperform because there's yep. Oh,
Yeah. So I get what Bob's basically saying is you maintain value by holding the gold in your savings account, regardless of what what the rate of return is. You're maintaining value. It's return of your capital, not return on your capital,
Right.
that
All
actually
right.
matters.
So I'm going to interrupt Gnostic only because I'm down to 2% power on my phone. So rather than people go, "Oh, the space blew up," I'm actually going to end it. And so, Bob, you were phenomenal. Seriously, we're going to have to do this again. This is like precious metal for nerds. This was awesome.
Hey,
There's so much.
hey, watch it,
sure.
watch it.
Hey, and there's so much we didn't talk about. We got to do this again. Seriously, like I mean, people leave it hanging. Like, why would silver and platinum go up more than gold? I don't want to start that because I'll be down to 1% in a second. So anyway, Bob, I can't thank you enough. We're going to do this again. This has been fantastic. For everyone here, we've got Edwin Dorsey tomorrow at 5 o'clock. The Bear Cave. He does all his forensic accounting stuff, and that should be a great space. Bob, thank you so much. This has been
My
terrific.
pleasure. Thank you, George.
Thanks, George.
Thank you.
Yeah.
Thanks, George.
Thanks, Carpathia Gnostic, and I forgot who was here before. But
Thanks,
anyway,
George, Jilly,
this has
Bob.
all been great. See you guys tomorrow. Take care. Good night. Thanks, Bob. Thanks,
Okay,
Bob.
thank you.
Thanks, Jilly. Bye-bye. Bye. Bye.